Welcome back. In this video, we are going to look at Bollinger Bands. Bollinger Bands are named after John Bollinger, who combined his knowledge of statistics to create an indicator called the Bollinger Bands. Bollinger Bands consist of three lines. First of this is the moving average line. So for example, here you see the three lines. This middle one is the moving average line. The other two lines are plotted certain deviations away from the moving average line. So here the upper band here is constructed by adding two standard deviations to the mean value, while the lower band is constructed by subtracting two standard deviations from the mean value. Now you might naturally ask, why is standard deviation used to create these two bands? Standard deviation is a measure of volatility in the prices of a stock. Hence, it reflects the variation in stock's price around the mean. If the stock's price were assumed to be normally distributed, then a range of two standard deviations from the mean reflects the range where the stock's price would lie 95% of the time. Since standard deviation is a direct measure of volatility, the more volatile the security's price, the wider is the range between the two outer lines or the outer bands. So for example, here the two bands are far away from the moving average line because there is high volatility, but as the volatility decreases, these two bands come closer to moving average line. Bollinger Bands can be used to create trading strategies that can be easily computerized and tested. A common strategy using the Bollinger Bands is to sell a security when prices reach the upper band and buy the security when it reaches the lower band. So the strategy will give a buy signal along these lines, which is where the prices reach the lower band, and the strategy will give a sell signal when the prices reach the upper band. As we explained, since a range of two standard deviations from the mean reflects the range where the stock's price would lie 95% of the time, the idea is that prices have high probability to revert to the mean. This kind of a strategy assumes that the security's price will stay within bands. This kind of a strategy is likely to lead to a larger number of trades, but it also limits risk because the trader can quickly exit unprofitable trades. But in the event of a sharp price movement and a change in trend, this strategy would not be profitable. So this strategy would only work when the markets are relatively less volatile and the prices are in a consolidation phase. Now prices of most securities spend around 30% of time in the trending phase and around 70% of the time in the consolidation or the corrective phase. So when prices are in a corrective or consolidation phase, they are likely to be less volatile and the prices are likely to trade in a comparatively narrow price range. So you can understand that in such a scenario, using this strategy can give very good returns. But as soon as there is a sharp price movement and change in trend, this strategy is likely to incur losses. Keep this in mind that many times long-term investors also buy on a significant breakout above the upper boundary band because a major breakout would imply that a change in trend is likely to persist for some time. Similarly, a long-term investor may sell on a significant breakout below the lower band. So for example, a long-term investor may buy on a significant breakout above this upper Bollinger Band because such a breakout may imply a change in trend that is likely to persist for some time. Similarly, a long-term investor may sell on breakout from the lower Bollinger Band in the anticipation that the downward trend may continue for some time. In this strategy, significance of a breakout will be defined as breaking above or below the band by a certain percentage point. So for example, if the prices move 3% above the band, one may buy the security or if the prices move below the lower band by 3%, then one may sell the security. With this, we have come to the end of our discussion on Bollinger Bands. In the next video, we are going to look at momentum oscillators.